Hello, everybody. Welcome back to another episode of the Investor Motivation Podcast. You have myself, Amy Lehmann, and the Captain, Robert Goudie.
Amos, how are you?
I'm good. How are you?
Very well, thank you. Very well.
That's good.
What's this week look like for you?
This week, yesterday we took the team down to Melbourne for a bit of a summit. So just a day with learning and, took the whole back office staff, which was really good. And I think, everyone's in a pretty good mood and happy to have that conference day just to really reinvigorate us and about the industry as well. So
Yeah, saw some great speaks. Artificial intelligence seems to be, as always, top of the cream in terms of the conversation, and so definitely really valuable and got us in amongst lots of other financial advisors doing very clever things, and that's where a lot of the learning happens. Amy, what are we going to chat about today?
Today we're just going to answer a few questions that we have looked up. We always invite people in to give us topics to talk about for podcasts, and then sometimes when we're having a bit of lull and not sure what people want to hear, we just thought we'd do a very quick fire of the most common investment questions.
Yeah. So what we've done to get the most common questions is we've gone to Answer the Public, which is a great spot you can put in investing, and it'll give you the can, how, which, why, and so on, and really what people are thinking about, and that's what we're trying to do to make sure we can add as much value as we possibly can for the time we have.
So these are the most commonly searched questions.
All right, first one, we'll take it in turns, we'll make it up as we go. First question, so it's a can investing make you rich?
Yeah, absolutely it can. Of course, there are many different ways to go about it, so it would depend on the way you do want to go about it, making sure you're investing into the right asset classes, the right assets that have that future growth potential. It can make you rich, but it can also take all of your money in the worst case scenario. So yes, it can.
Yes, yep.
But just making sure you do the research, educate yourself on the markets, and making sure you are investing too, not just speculating. I think that that's something that we probably don't talk about too much, but is really important. Investing is for long-term capital appreciation, whereas in speculating is just throwing money at something, hoping and thinking that it might rise in price, but not really understanding fundamentals and how to actually assess whether it will or not.
Yeah, cool. So we're not talking about trading, we're talking about investing over a long period of time. So the answer is yes, of course, investing can make you rich. It's the only way you actually can do it. There is a second can question that has still got quite good search views. Can investing be a full-time job?
Yeah, it absolutely can. That's why, fund managers exist, ETF providers, they are full-time jobs that take, 8 hours every single day, 5 days a week to research markets and professionally invest for themselves and other people.
Researching sectors. So fund manager world, let's say it's a global equities. So what we mean by equities, global businesses. There'll be people in there that just spend their life looking at 2 or 3 stocks within the healthcare sector that they need to know at a very deep level who runs it, what are the people like, what is their track record, and so on. So the answer to that, if you do have, obviously investing might be a hobby or it's just something that you're very passionate about, it can absolutely be a full-time job. And I think I'm one of those lucky ones that I'd say I am, a full-time investor. And I think that's good. And we will get to we are streaming on some of the socials as well, and we'll backtrack and have a look at some of those questions as we go.
Yep. Okay, my turn for a question for you.
Yeah, go for it.
Can investing put you into debt?
Well, can it put you into
you on the
debt?
spot here.
Yeah, no, it's a good question. It's not really well searched. But
without context.
Can it put you into debt? I suppose the answer to that is yes, potentially it can. That there depends what sort of level of liability that you might have. Just being a shareholder in a public company, that business would have debt within it. Now, if that business went broke, would that mean that you're responsible for that as a shareholder, one amongst thousands? No, that business would go broke and you would lose your capital. So probably to answer that, no. If you're to buy a private business and there is debt within it, or you've got to take on debt to keep the thing going before it, then potentially
Yeah.
It can put you into debt. Most businesses take on debt to obviously further the business, to make it bigger, make it stronger, to reinvest into their products and services. So using debt wisely can be a very positive thing. But for those people that are investing to residential investment properties or margin lending into shares, these are decisions that people are making. Will it just inadvertently happen to you? Probably not.
No.
That
Yeah.
would be extremely rare, unless you're buying into a sort of private business where
Yeah.
you really haven't been shown the numbers or weren't told the numbers properly, and someone got screwed over. That can
Yeah.
happen.
Yeah. So yeah, I guess if this question is, can investing into the share market put you into debt, then really the answer is no, because whatever you purchase, if you buy a business for $100 and that business goes bankrupt, you would lose your $100, but you wouldn't be required to go into debt to get your money back or anything like that. Yeah, it's a limited liability in that sense.
Yep, very good. Now let's go to a how. How investing work? How does investing work?
Like I just mentioned, investing works. You would pick a business or an asset that you'd like to purchase, decide on that amount. If it's $100, put your $100 towards that purchase, and that you would hold that if you were investing for the long term, and hopefully that $100 grows into many more.
And I think investing is probably the key here. That you're investing, the $100 per week, per month or whatever it is, to invest and to become rich over the long term. It's a slow process. Everyone's after the shortcut. There is generally no shortcuts. The people that have created significant wealth over time, more often than not, are business people. And if they're not in business, I've seen plenty of people do this. They've invested into businesses over a very long period of time. They have owned Wesfarmers since the 90s. They've owned Commonwealth Bank since the 90s, CSL since the 90s, that they were investing small amounts, that over the duration of time, and a lot of time, it just, the businesses grew.
Compounding,
Compounding. They reinvested because they were still working. They were not taking all the dividends. So reinvesting back into their portfolio. And for those that are running their own business, which is what Amy and I have done and doing at the moment, that we reinvest constantly into education, the right software, the right tools to provide great service and products to our clients.
Yep.
So, you need to stick at it, invest regularly, constantly, over decades, and that will potentially make people rich. Well, it nearly guarantee you to make you rich if you do enough over a long enough period of time. Yep. The stats around Warren Buffett worth, billions upon billions of dollars, that the majority of his wealth was created after the age of 55. But he started to invest so early in life that he had that early money compounding for him very early.
Yeah. The key. And I think we had that conversation in the car on the way home from Melbourne yesterday that, for young kids, I guess, under 18 minors that work for their first time, we actually discovered that it's not mandatory for an employer to pay super guarantee into super for them unless they work over 30 hours a month.
A week.
A week. Which we thought was really sad, because they do miss out on all of that compounding from such a young age for the entirety of their life, when, in fact, that's the most important time for them to be getting the superannuation.
Money is more important.
Yeah.
Very good. Now we're moving on to the what's. This is a question for you, Amy. What investment platform should I use? And this is one I see on socials all the time. Thoughts?
Well, for me, it's whatever is going to be the easiest sometimes. So, of course, fees do come into, play. But generally with investment trading platforms these days, they're all so competitive that they're, a couple of dollars difference between them. Some can be free, but there's restrictions and not the whole market available to you. So just figure out what's important. If you need Australian and international, if you want your bank account to be linked up, so then you would go do the ANZ trading or the NAB trade or the ComSec if you're with one of those banks already for ease. But really, it's just a personal preference. They're all very, very competitive these days.
Yeah. For me, if I was to look for something, obviously there's ComSec Pocket, which I did a review on in recent times, we know Beta Shares have a platform, and I think that's free trading. But of course, the majority of the investment options are Beta Shares ETFs, which we use. They are very high quality and solid investments, solid ETFs. But obviously, you're going to be restricted, as you said. But for me, I would be looking for something that gives you full range, Aussie direct businesses, so on the ASX, not just ETFs that you can go and buy CSL. You've got access to overseas markets as well, not just here in Australia. So if you want to buy Google or Microsoft or Apple or Visa, you've got the ability to do that. Please note this is general advice only, of course, but that's what I would look to be doing. I would find the one that works for you and then move on, because it's a bit of a roadblock for people to decide which one is best. You can spend lots of time working out which one is best, and they are generally all the same.
Absolutely. All right, let me find one for you.
Okie doke.
Oh,
So I'm highlighting some, but that may not be the ones you're after. You just want the ones that are the most orange?
why investing is important.
Why is it important? I think that's a fantastic one. I think investing is important. One, for me, it is actually fun. You are watching what businesses are doing. I like to buy direct businesses, which is something I've done my whole life. I do it personally and professionally. Buying a business and reading their quarterly or half-yearly reports, it's nearly a hobby. I know it sounds nerdy, but I like to do it. Now, a lot of people say, well, that sounds great and that's good for you, Rob, but why would I do it? Well, financial independence. I want future options to go and do fun stuff with those that I love, and go and do fun shit, because life's for living. So becoming financially independent provides future optionality for me to go and do fun stuff. And that's just, obviously, that's life. I use this quote all the time. It's our job in life and retirement, but life in general, to build memories to reduce future regret when we are too old or can't physically get out and do it. The regret will eat us alive. So I think it's really important that go and do fun shit, and money can help with that.
Yep, no regrets policy.
That's right. But I've also seen people that have accumulated great wealth, and part of their strategy was being so incredibly tight with their money that it affected every decision they had. So it actually wasn't healthy. It was whilst the wealth was there. But I've also seen those people, because I know them well, that I've seen them change from being so tight and accumulating to now so relaxed and also generous. And that happened for the person I'm thinking of. Well, we're talking between probably 65 and 80, and it's been amazing to watch.
Yeah, life-changing.
Life-changing, not just for him, the hard yards he did earlier, and this was the classic getting rich slowly. He invested progressively and constantly, and invested into direct equities via broker back in the early 90s, late 80s. And, we're talking about portfolios that are in excess of 8 mil. He's been able to help out children when they've needed. And that generosity has only kicked in the last probably 15, 20 years, whilst being independently wealthy and retired for a very long time. Yeah.
Financial independence and freedom, and being able to enjoy it not only for himself now, but experience that second-hand enjoyment from gifting to children. And not only, a lot of people set that up in the will for the future generations to receive at that time, but he gets to see the joy he is bringing to other people around him. So that's double whammy.
Pretty cool. So now back at you, Amy. If you're investing into a company, a direct business, which not many people do, but if you were to do that, what do you look at? What characteristics are you after?
If I look at any businesses, the first thing before even actually looking at the businesses would be the thematic of that business. So what sector do they play in? Are they healthcare? Are they AI? Are they computing power, cloud, cybersecurity? What's their theme, and is that theme got some tailwinds behind it? I think all the ones I just mentioned definitely do have that tailwind behind them. And I'm looking for that long-term investment thematics. So not so much the short term, which I think a lot of people talk about online. Probably too much air and too much limelight goes to those consumer cyclical businesses and trying to get in on that yearly cycle. But yeah, for me, it's just about that long term investing into those thematics. Of course, whenever there is a founder led business with skin in the game, that's very, very appealing. And there definitely are a few Australian businesses like that. They are obviously, the longer a business is listed on the ASX, the more diluted the founder ownership is. So that then plays into that small mid-cap companies, which I think are just really fun for people like us that are highly interested in investing into businesses and researching them, trying to find those, 10 baggers early.
Yeah.
Easier said than done, but lots of fun.
Yeah, absolutely. So that's part of the challenge. So in terms of spoke about the sector and is it a growth sector? Do they have tailwinds? But what about what about the company itself? Within the company, you mentioned obviously that the people running it have skin in the game. They own some or a lot of it. That is a big plus.
Yep.
What about the fundamentals, the financials? What are we after?
Yeah, of course, you want to make sure that they are a profitable business. So a lot of that small and mid-cap space are unprofitable at time of listing because they need that capital to invest into the business further, which then leads me on to dividend payout ratio. So making sure the company isn't paying out, a majority of the revenue that they do receive and that they keep a majority of it to reinvest into themselves for that long-term price uplift. So definitely financials are important, more assets than liabilities so that there's not short-term or even long-term risk of needing to repay debts and they can't afford to.
Yep. And strong balance sheet.
Yeah, it's that assets over liabilities.
We speak a lot about debt. Debt is the common denominator. When a business goes into administration, a household or an individual goes bankrupt, it is generally always debt behind it. And I think in Australia we have, and this has happened globally, definitely in America during the GFC in 07, 08, 09, that in America debt was disrespected and that nearly brought the whole system down. Australia, there is high debt levels as well. Now, Amy, I've got just another sneaky question for you. Yesterday you sat in on a private equity session. Private equity, private credit, private everything just seems to be a theme at the moment that everyone is talking about. Can you tell me what you learnt yesterday? Let's focus on the equity side, which is private businesses.
Yep.
What's happening in that space? Was that the session? I wasn't in that one.
Yeah, private markets. So it was about private debt as well as private businesses, which are really one in the same. So these are getting investments or money into investments that, so for example, there's the share markets, publicly traded businesses, they receive investment from the people that purchase the business. So that's capital for them that they can then use to research, develop anything to expand their business. People that don't go publicly listed have to source capital elsewhere, which generally could be one of the big banks, but then it may be a private business. So if it's a private business, this is that private equity, private market.
Yeah.
So you can purchase managed funds, which is essentially a business that lends capital, gives money to businesses that need it, and then get some skin in the game of that business.
Yeah. And there's quite a few large private equity players, companies, so these are listed businesses themselves, KKR, and I think we looked up when we were sitting down snacking on the odd Monte Carlo or having a discussion around the Arnott's biscuit that KKR, an American business, owns Arnott's, the biscuit manufacturer. So there's be a lot of brands out there that you are consuming that are actually owned by private equity firms that are not Australian. So when you ever seen on the news where certain companies, what you think are Australian, are actually owned by a multinational, that's often what happens. It's been picked up by a private equity firm.
Yeah.
Yeah. And obviously they're very clever. Often when you see the airlines go under, all of a sudden you'll see private equity swoop on in to grab up this business when no one else is interested.
Yeah, absolutely. They save that business's life by lending money to that business for a stake of ownership. So it's another way to access businesses that you generally can't otherwise access on the share markets.
Yep. Fantastic. I think it's your turn because I added in two. So we're just looking at the screen to our left, which has got all the questions that Answer the Public have come up for us, and we're going for the deeper oranges if we can.
Oranges.
Yeah.
All right.
Only if it's appropriate, of course. Oh, that saving one's
This is
interesting.
very saving. Why investing is better than saving.
Cool. Okay, well, I think you can't invest unless you save. So let's just get a definition between the two. That saving is, and this is rule number one, that you need to spend less than you make. So if you do not spend less than you make, then you're not in a position to save. Now, saving into a bank account where you watch that cash build up is the first thing. But I think investing into cash is absolutely no long-term investment strategy. I don't call that investing. But once you get up to a nice buffer, it might be 5, 4, 6 months of sort of cash flow needs that is there in cash that can sit there, and then anything above that can then be invested. So the reason why you have that cash buffer is really an emergency fund that if something happens, you've got there to cover off some short-term needs, and you're not forced to sell your investments, which if you're investing via the share market into ETFs, managed funds, or direct investments, this is where you're going to inherently get volatility. And you do not want to be a forced seller at an inappropriate time. And what I mean by an inappropriate time is when markets go down and people are panicking. You don't want to be the panicker. You want to be the buyer during those times, not the panicker. So I think, I do not believe that cash is a long-term investment strategy by a long shot. You need to invest in a way that allows your money to grow and provide return comfortably above that of inflation. And cash, TDs, high interest savings accounts are not going to do that enough. Very good.
Beautiful.
You're welcome. So you've just found a bit of a hack there that you've got so much more orange that you want to chat about.
Yeah, there's a lot more orange
Yeah.
that pops up.
Did you have one that you were going to throw at me?
Bonds are investing in, well, actually, let's make it term deposits because it's a little bit more accessible for a lot of people.
Yep.
Are investing in term deposits safe? And actually, is term deposits an investment?
Well, look, they are an investment, and I don't think it's a investment strategy. I probably could have worded that one a little bit better. I don't believe it's an investment strategy, but of course they're an investment, and so is cash. But essentially, a term deposit, you are lending money to the bank, and they are giving you probably now around 4%, 4.2, somewhere there. They are taking that money and they then obviously put a margin on it as they lend it out to our highly geared consumers in Australia.
Yeah.
So they are in the business of taking that money and lending it on to a third party that you don't know where that money's gone to that you've lent. That's the margin. It's an amazing business. That's why our Australian banks are so large. And yeah, so
Are they safe?
are they safe? Yes, they are safe. Up to per institution, per entity. So they are government guaranteed by the government up to $250,000. Now, what I mean by institution, so let's use Commonwealth Bank is the institution, the bank.
Yep.
And I can have a self-managed super fund. 250 there is guaranteed in my individual name, guaranteed in my company name. That 250 all guaranteed.
Yep.
That's the short term. Are they safe long term? No, they're not. And that is because inflation will erode the value of your cash and term deposits over the long term. It is a death by 1,000 cuts. You will not see it coming.
Yeah. Unfortunately.
Yeah, it's not till the decade has passed where, and I, even as a, in the 80s, when I was at school, you hear of someone selling their farm and having $500,000 in the 80s, and this is just a monstrous amount of money. And now, most of our farmers locally here, and also we're very lucky, we look after a lot of high net worth clients that have sold their farms and then need help with the proceeds. But $500,000 then it's just not going to cut it now. When they put their crops in this year, that cost them well in excess of 500,000.
Yeah.
And when people are coming in now with their investment money, it's closer to $5 million and above.
Definitely. If they invested that, sold the land back then for 500,000 and only went into term deposits, today that would not be, nearly enough of what they would need.
Yeah.
Whereas if they put it into the markets and had that higher rate of compounding over the years, if you do that compounding math on Money Smart calculators, the difference would be astronomical.
It's off the charts.
Yeah.
Percentage, percentages in front. But even for those people that come in with such a large amount of money from a sale of any business, you might think, oh, I've got that much, I can just put into a term deposit. And this is where you need to explain what risks are you comfortable to take. Are you comfortable to have the value of your money eroded, or are you comfortable with short-term volatility? I can teach people about short-term volatility because it happens on a daily basis in the markets. It's much harder to teach about the risk of inflation that happens, so slowly, so progressively over decades. But for those clients that could comfortably live off the income by investing conservatively, if they've got $10 to $15 million, there is also a responsibility that I believe that to look after the generations ahead, and hopefully educate those generations to make great decisions. So it's not just blown up in the preceding two generations, which is what normally happens.
Yeah.
Very good. My turn, is it?
Sure, if you've got one.
I've got one. Let me
We'll
have
go
a
lucky
look.
last.
Lucky last. And I saw a few other questions. We might have a look at those as well. Was there some good stuff there?
So even now, I'll just have a quick look on TikTok and see if there's any questions coming through.
Cool. There was definitely a few there. That's just part of our live streaming. I think this is probably more of a question for me that most people do have, unless you've got a ripping one there at all, Amy.
Sure, let's just go with Pengu's question here. Rob, do you recommend Forex or crypto?
G'day, Pingo. No, I don't. We don't. So foreign exchange. No, that's a trading world. We are pure investors. We are not traders. When it comes to crypto, now obviously people that have invested into crypto in the past, there are plenty of people that have made a lot of money. I acknowledge that, but for me, it's uninvestable. It has no intrinsic value. You are essentially buying it, hoping someone will pay more for it than what you paid.
Which is that speculating piece that we kind of mentioned earlier.
That's right. Where we invest is investing into businesses where there are products and services that are ultimately improved constantly over a long period of time, and that it improves, obviously increases the sales, increases the revenue and profitability, and that is something we can value. Yeah. That is something that we are prepared to pay for, today, and also for the future growth that we may see in that business. Is cryptocurrency or is Bitcoin going anywhere? No, I think it's going to be about for longer than me. But is it investable for myself or for my clients? For me, no, it's not.
No.
Thanks, Bingu.
Yeah, I think that's a great one to round it off.
Fantastic. I think we're done.
Yeah.
Excellent. And thank you very much for tuning in. If you do have a question for Amy or myself or Rach, who also joins us on these podcasts, please let us know in the comments. And if you could, catch up with Amy. You're on TikTok and Instagram and Facebook.
Yep, Amy Lehmann FA.
Cool. And Rob Goudie on TikTok with underscore. Just be careful of the many fakes that are out there in social media world. Very good. Thank you for listening, and cheers. Take care.